What if, while you were sleeping tonight, money was flowing into your bank account? Not from a lottery ticket, not from a get-rich-quick scheme, but from a system you built, brick by brick, using one of the oldest wealth creation tools in human history: real estate. Let's be clear about something from the start. Passive income doesn't mean no work. It means the work you did yesterday pays you today, and the system you built last year keeps paying you next year. In the world of personal finance, passive income is the holy grail, income that flows without your direct hourly involvement. And no asset class has created more millionaires through passive income than real estate. Consider this. According to the Federal Reserve, real estate accounts for roughly 40% of American household wealth. The Rockefellers built their empire partly on Manhattan real estate. Carnegie held vast property portfolios. Today, the strategy is democratized. Regular people, teachers, nurses, engineers, are using it to generate thousands of dollars in monthly cash flow, often within 5 years of their first purchase. The question isn't whether real estate works. History has already answered that. The question is, how does it actually create passive income, and how do you get started? The most fundamental form of real estate passive income is the rental property. Here's the core concept. You buy a property, you find tenants, the tenants pay rent, and that rent after expenses becomes your income. But the beauty goes far deeper than that. When you use a mortgage to buy a property, your tenants are essentially paying down your debt. Every single month, your equity grows. Meanwhile, the property itself tends to appreciate over time. And in most cases, you can write off depreciation on your taxes. You're winning on 4 fronts simultaneously: cash flow, equity buildup, appreciation, and tax advantages. Let's run some real numbers. Say you buy a single-family home for $200,000. You put down 20%. That's $40,000. Your mortgage, taxes, insurance, and maintenance come to roughly $1,200 per month. You rent the property for $1,600 per month. That's a positive cash flow of $400 monthly, or $4,800 per year. That's a 12% cash-on-cash return on your $40,000 investment, before appreciation, before equity paydown, before tax write-offs. Now imagine having 5 of those properties. Now here's where it gets really interesting. Sophisticated investors don't just buy and hold. They use a strategy called BRRRR: buy, rehab, rent, refinance, repeat. Here's how it works. You find a distressed property selling below market value. You buy it, fix it up, and force the equity through renovation. Then you rent it to a tenant. Once it's stabilized and appraised at its new higher value, you do a cash-out refinance. The bank gives you back most or all of your original investment, based on the new appraisal, which you then use to buy your next property. Done correctly, BRRRR allows investors to recycle the same capital over and over again. Instead of needing $40,000 for every property you buy, you're essentially using one pool of capital to acquire multiple cash-flowing assets. This is why some investors go from 0 properties to 10 in just a few years. They're not earning more money at their jobs, they're deploying the same dollars more efficiently. Another powerful variation is house hacking: buying a small multifamily property, living in one unit, and renting out the rest. Many investors report their tenants completely cover their mortgage, meaning they live essentially rent-free while building equity. But what if you don't want to be a landlord? What if you want the returns of real estate without dealing with tenants, toilets, and termites? That's exactly where real estate investment trusts, or REITs, come in. REITs are companies that own income-producing real estate: office buildings, shopping centers, apartment complexes, data centers, and more. When you invest in a REIT, you're buying a share of that portfolio. By law, REITs must distribute at least 90% of their taxable income to shareholders as dividends. That means you get a steady income stream without owning a single property. For accredited investors looking for higher returns, real estate syndications offer another path. A syndication pools money from multiple investors to purchase large assets, apartment complexes, commercial buildings, storage facilities that no single investor could buy alone. A professional operator manages the asset while passive investors collect quarterly distributions and a share of profits when the property is sold. Returns on syndications can range from 8 to 20% annually, depending on the deal. The trade-off? Your capital is typically locked up for 3 to 7 years, but for patient investors building long-term wealth, that trade is often worth it. So you're convinced real estate creates passive income. But how do you actually get started, especially if you don't have hundreds of thousands of dollars sitting in a savings account? The truth is, you have more options than you think. First, house hacking. As we covered, buying a small duplex or triplex and living in one unit keeps your entry costs low, while offsetting your mortgage immediately. Second, if you're not ready to buy, REITs give you exposure to real estate for as little as $10 through platforms like Fidelity or Vanguard. Third, if you have a solid credit profile and a steady income, conventional loans allow you to buy a property with just 3.5% to 5% down on certain loan programs. The biggest mistake new investors make is waiting until conditions are perfect. They wait for interest rates to drop, prices to fall, or their savings to double. But the investors who build real wealth, they get started with what they have, where they are, and they refine as they go. A quick word on risk. Real estate is not a guaranteed win. Markets fluctuate. Vacancies happen. Repairs are never cheap. The investors who succeed long-term are the ones who study their markets, run their numbers conservatively, and never over-leverage. Treat it like a business, not a lottery ticket. Do the homework before you write the check, and you dramatically increase your odds of building income that outlasts your career. Real estate has built more generational wealth than virtually any other asset in history. The strategies are learnable, the numbers are understandable, and the results, for those who commit, are life-changing. If you found this valuable, hit that subscribe button, because every week we go deep on the strategies, stories, and systems that real investors use to build financial freedom. Your next chapter starts now.